Hi, everyone, and welcome to our quarterly update. Since it's the final quarter of the year, we're going to be focusing on some tax strategies, and this time around, you'll get to hear from the whole team. We're talking about tax loss harvesting, donor advised funds, and Roth conversions. This video is very much a bird's eye view, so if you have any questions about how these strategies apply to your specific situation, please let us know. We would always love to hear from you. Likely, we've discussed these with you already this year, or will do so before the end of the year if they apply to you, but we would love to hear from you in the meantime if you have any questions. Enjoy!
Hi, this is Randy Bruns, and I am going to explain tax loss harvesting and explain why it can be such a valuable strategy during market pullbacks like we've seen so far in 2022. So let's just talk about what is tax loss harvesting. First of all, tax loss harvesting is basically realizing or harvesting capital losses purely for the tax benefits of doing so. Why would somebody do that? Well, reasons could include offsetting capital gains somewhere else in your portfolio. You might do it to replace an expensive and or tax inefficient mutual fund somewhere in your portfolio. Or you could use it to deduct against ordinary income on your tax return. The IRS currently allows you to deduct capital losses up to $3,000 or up to $3,000 against your ordinary income in any given year if you file your taxes married filing joint or as an individual tax filer. You got to pay attention to something called the wash sale rule, which basically stipulates that you cannot buy back the same or a substantially identical security within 30 days of the original sale. So in other words, you can't sell Tesla stock, for example, at a loss and then buy it back the very next minute, because the IRS would say, yes, you lost money on it, but you just bought it right back. You didn't get out of the market. You can buy it back, but you got to wait 31 days. As far as a substantially identical security, an example would be you have the Fidelity 500 index mutual fund that you invest in. It's down in value. You cannot sell that, recognize a loss on your taxes, and then buy back the Vanguard 500 index. The IRS would say, yes, it's two different fund companies, but it's substantial. Those investments are substantially identical because the underlying index is still the S&P 500 index, basically. A real life example of a tax loss harvesting strategy that would work. Let's just take Mary, who owns an actively managed U.S. growth stock mutual fund that's worth $200,000. She started it with $300,000. It fell to $200,000. She's got an unrealized loss of $100,000 that she wants to recognize, so she does. And then she turns around and replaces that actively managed mutual fund with an index fund that invests in U.S. growth stocks. That would allow her to recognize the $100,000 loss for tax purposes. Why? Because those are not substantially identical funds. Mary can therefore report the $100,000 loss on her taxes while remaining invested in U.S. growth stocks. One thing that's important to note also is unused losses can be carried over into future years. It could be future years to, in the case up here where you could deduct, let's say you have a $30,000 loss and you have no capital gains to offset them with, you could use up to $3,000 per year and you could do that for 10 years in the $30,000 example. Until the $30,000 loss is exhausted, but you could also use it. You could also use the $30,000 loss against capital gains next year, for example. You do that with IRS Form 8949 and Schedule D. If those sound like a foreign language to you, congrats. That just means you're a human being who doesn't study or do tax returns for a living. That's why you have your CPA or a firm like ours. We can help you with that. The last item to note is that a lower cost basis for your replacement security can result in a greater capital gain down the road. But that could be offset by lower tax brackets. Say you do this during your peak earnings years and in retirement you eventually recognize the capital gain, or a stepped up cost basis for your heirs. So let's use the example where you have $200,000 on the replacement security. It grows to $500,000. You die. Your heirs inherit the $500,000. Well, the IRS allows them to step up the cost basis to the value on the date of your death. So in other words, they would say, hey, when we inherited this, this was worth $500,000. That means they just got a $300,000 capital gain tax-free thanks to something called the IRS stepped up cost basis rule. If you have any questions about any of this, feel free to contact us, but we hope you enjoyed this video.
My name is Alex Offerman. I'm going to take a couple minutes today to walk through optimizing charitable giving through a donor advised fund, or a DAF for short. Donor advised fund has been a hot topic in personal finance over the past couple of years, and we just want to take a couple minutes to explain what a donor advised fund is, what it isn't, how they work, so on and so forth. So without further ado, a donor advised fund is a simple, flexible, tax advantageous account where you can donate cash or appreciated securities and distribute to charities over time. There's 6 main pros in our eyes that we look at a donor advised fund, and those pros include eligible for a current year tax deduction. So hypothetically, let's say you wanted to donate $10,000 to a donor advised fund, but you want to do that over the next couple of years. You are able to donate $10,000 all up front to a donor advised fund, get the tax deduction for it in the current tax year, or likely get a tax deduction for it in the current tax year, and then tell the donor advised fund to make grants over the upcoming 1, 2, 3, 4, 5 years, but you're still eligible to make that or get that deduction for it in the current tax year. You're also able to contribute a wide range of assets. This can be mutual funds, stocks, bonds, privately held securities. It can be your home, for example, can get donated to a donor advised fund. It accepts a wide range of assets. You can potentially avoid capital gains taxes. I'm going to dock the explanation of that here for the next 2 slides, just for the fact that we have a very good case study that we'll walk through that explains that a lot better. 4th is bundling contributions. Due to the Tax Cuts and Jobs Act of 2017, which increased your standard deduction, it has therefore made it a lot harder for individuals to itemize their tax return, and you have to itemize your tax return on your taxes in order to realize or to be able to utilize your charitable contributions. So bundling contributions, let's say hypothetically you donate $10,000 this year and donate $10,000 next year. By doing that all in the current tax year, donating $20,000 to a donor advised fund, you're able now to likely be able to take a itemized deduction on your tax return, which will therefore lower your tax bill at the end of the year, and you're still able to distribute those funds in this calendar year and also next calendar year. So it's really cool how you're able to bundle contributions, make a higher amount for your item, so you can itemize, lower your tax bill, and then ultimately still grant grant over the course of 2 years if that was your ultimate goal. The 5th thing is investing your donation. So, for example, you donate $10,000 to the donor advised fund and you wanted to reinvest that to allow it to grow into the future and hopefully be able to donate a lot more than that $10,000. You're only able to deduct that $10,000 initial contribution that you made, but whatever it grows to is benefiting all charities that you would like to benefit for or have that benefit for. Last but not least is simplifying record keeping and organization. We all have at the end of the year when you make your donations to all the charities and you have all of these receipts that you want to make sure that you keep, and if you ever get audited by the IRS, the donor advised fund makes that very simple and streamlined so you don't have to worry about that. How does a donor advised fund actually work? You as the donor would open one up, donate appreciated securities, cash, whatever you would like. As I mentioned, that you can have there's a wide range of acceptable assets that can be added to a donor advised fund. You again get that immediate tax deduction for those contributions in that current tax year, but then you're able to make grants with that money over time to whatever charity of your choice. So that again, that could be next year, that could be in 3 years, that could be in 5 years. There is no time limitations to making that deduction or to making those grants once it has been donated to a donor advised fund. And last but not least, a little case study that explains the capital gain conversation, or avoiding capital gain, that I referenced in the second slide. Let's say hypothetically you bought $5,000 of XYZ stock 10 years ago. Federal long-term capital gains rates of 15%. That's what I currently are now. This is excluding any state income tax. And let's say the current market value of XYZ stock is $50,000. So you have a $45,000 gain. You had $5,000 of your that you invested in there. It's now worth 50. The $45,000 of gain is baked into there. So let's say in option 1, you sell XYZ stock and then donate the after-tax proceeds. So you take your $50,000, you sell it, $45,000 of it gets taxed at a 15% capital gains tax rate. That would equal $6,750. And then you're able to donate $43,250 to the charity, which you'll ultimately get a deduction for that amount as well. Versus option number 2 of just donating the $50,000 of appreciated securities directly to the donor advised fund. You do not have to pay long-term capital gain tax rates on that because it was donated directly to your donor advised fund. So you would be able to take a deduction for the $50,000, which allows you to have an additional $6,750 that you are able to grant out over time to whatever charity of your choice, charity or charities of your choice. That is what a donor advised fund is. We would be more than happy to walk through this and in your particular situation and see if this is a valid vehicle for you. We'd be more than happy to do so. So please do not hesitate to reach out with any questions.
Now let's talk about Roth conversions. What are they and when is it a good time for one? For starters, let's review some retirement account basics. The funds in your traditional IRA and 401k are tax deferred, so the tax bill comes due in retirement when you start removing funds from those accounts. In contrast, money goes into a Roth IRA after tax, so it grows tax-free and then no income is owed on retirement distributions. You may not have contributed much to a Roth IRA during your working years because of income limits, but you can still add money to a Roth IRA by doing a Roth conversion. So, a Roth conversion moves assets over from a traditional IRA to a Roth IRA. Roth conversions count as income in the year in which they are completed. So you can complete a Roth conversion at any income level and in any amount. I'm sure the IRS would love for you to just convert your whole traditional IRA right on over and pay a massive tax bill, but we recommend doing this in a more strategic way. So this moves to our next question of when is the right time for a Roth conversion. To answer that question, let's look at a sample income tax illustration. This graph illustrates the income tax for a higher or income earning couple from their 50s through the rest of their life. As you can see, they're paying pretty high income taxes here at the end of their career, and then there's a steep drop off when they retire at age 62. For about 10 years, they are in a very low income tax bracket, at which point they jump back up at age 72 when required minimum distributions, or RMDs, kick in. At that point, their taxes grow until the end of their life. You can imagine these low income years are a great time to realize some of that income that you deferred when you're a much higher 20 or maybe 30-something% tax bracket while you're in a very, very low tax bracket for a temporary amount of time. To do this, we complete a Roth conversion. We move those funds from your traditional IRA, paying income taxes in the process, where they will live in your Roth IRA and continue to grow tax-free. So, exact Roth conversion amounts will vary from person to person, but in general, this is a great way to optimize your retirement income. Not only are you realizing income earned in a high tax bracket at a much lower tax bracket, but you also are achieving a greater balance of pre-tax and after-tax assets in the long term. So, if you're retired but under the age of 72, this might be the right time for a Roth conversion. There are several considerations that determine the correct conversion amounts and when exactly you should do it. But if you have specific questions, please let us know. We love doing this kind of math and helping you figure out how to optimize your finances. So we would love to hear from you. I hope this was helpful. And again, if you have any questions, please let us know.